This conference will now be recorded.
Good morning, everyone, and welcome out to Investing Mentorships Trading Mentors program, July 28th, 2020. Crazy how time flies, even in the year of 2020. Hard to believe we're kind of moving past the midpoint of the year and getting towards later end of summer and into the fall and all of that. Time just flies. So, as always, just a reminder that everything we present is intended to be educational and instructive. Just make sure that you follow your trading plan and principles. We want this to be educational. Of course, we want it to be something that you gain experience, you gain learning, you gain an understanding of why traders do what they do, how they think about risk and rewards and probability and so on. But you need to make sure that you kind of follow your own path and just make sure that everything that you do fits with your goals and your expectations and that sort of thing. So with that, let's jump over here and take a look at the S&P. So last week we talked about, kind of an unconvincing breakout, and it definitely had that. I'm going to back this out a little bit further. Let's go back 8 months or so. We'll see the prior high. You'll see that we're kind of into this interesting zone. So when you gap, there's a couple of levels that are important when you gap. Where you gap to and where you gap from are significant. So this is kind of that gap area in the S&P. And then of course we've got the all-time high, which is just above that at about 3,400. So you have three pretty good levels of resistance. And I would say that the markets really tried to break out. And this line here that I drew at the gap, I kind of prefer that line to be drawn like this. I suppose this is the way that I think the line is maybe best drawn, in terms of, you can see it was support, and then it was kind of the gappy zone. And this is an important area. This area is one of those areas that stands out on the chart. This was really the start of the coronavirus meltdown. You came back up, so old support acted as new resistance as we recovered, this huge recovery. Notice it went head first into that area, and that's where it found a lot of memory, because this is an area that really stands out on the charts. Well, I would call last week's move kind of a false initial breakout. Now, it doesn't guarantee that it's going to continue to be a big false breakout, but that was the initial move, is just kind of, it had a false breakout to it. It didn't really expand. The candlesticks didn't increase in size. There was no major break and push, no huge increase in volume or anything like that. And so we kind of sunk back in. And from false moves, sometimes can come fast moves. So this is kind of your false move higher, and there is the potential that we could make a fast move lower. That false breakouts are kind of a way of sucking people in to the wrong trade and maybe triggering stop losses and that sort of thing, and then reversing hard and going in the direction it should have gone in the first place. It's kind of like, this is a little bit of an outlier, but they just kind of push the market up there, force that last bit of pain to the short sellers in this case with the upside move, and then proceed to kind of drop back down. We've talked about this area, which I would call the fourth wave. You kind of have this 1, 2, 3, 4, 5 pattern, as I see it. If you're using the Elliott wave theory of 5 followed by 3 and that sort of thing, you could say that these lows here are kind of that fourth wave. We had suspected that maybe it was more like these were your waves and this was your fourth wave. Well, looking at this chart, I wonder if this was just all kind of one wave. And that's the problem with Elliott wave or any technicals, is they're just not perfect. You're trying to do the best you can with looking at supply and demand, and that's all we're doing, is saying, okay, how much supply is out there, how much demand is out there, Where is supply likely to come back in? Where is demand likely to step back in? How does this match up with other factors and so on? And then make the best argument. It's kind of like laying out a case in court, make the best argument you can. And it's not perfect, it's not always just so super clean. There's a little bit of doubt here, a little bit of doubt there. But when we get a pretty good picture, we're just trying to kind of paint a picture of, okay, what's likely to occur. There is a lot of overhead resistance. Now, could the markets explode higher? Yes, they could. They definitely can in terms of clearing those resistance zones. Historically speaking, you get very good returns buying new all-time highs. So actually, it's easiest to make money buying when you're at new all-time highs. That's where the trend and the momentum and all those things really can take off, from the standpoint of buying. So new all-time highs would make it an easier buy than buying here, which is a little bit counterintuitive. Why would I not make more money, easier money buying at lower prices than at higher prices? Well, right here, we've got a lot of overhead supply and concerns and risk and so on. If we can clear all those hurdles, it just kind of sets clear skies ahead. Look at it from the standpoint of, when did we break out to new all-time highs? Well, if we go back a number of years, look at it. I'll go back a little bit further, maybe 13. We'll show the 2007 highs. But here's where the markets broke out to new all-time highs. That's an easy trade in terms of upside. Yeah, we consolidated for a while here, and then we broke out to new all-time highs. Much easier trade, And so we kept going higher, 13, 14, went sideways through 15, 16, 17, went sideways through 18, 19, 20. Now we're going sideways. Does it look a little different? Does this drop look different than the others? Yeah, of course. This one shows a lot more violence to it. You could make an argument that we kind of have an alligator mouth happening, which is an increasing volatility scenario, right? Where the waves become larger, you're not really going anywhere, but the volatility increases. So it's drop and then pop and then drop and then pop and then drop. And now we're in the pop phase. Could you get up to that top of the alligator mouth and then finally turn back down and so on? It's certainly possible, right? And so we're in a little different market environment. And certainly it's not as easy and straightforward as just buying the new all-time highs back here as we started to break out. That was, again, historically speaking, buying at new all-time highs generally gets pretty solid returns for a good period of time. That's easier bull market trading. Now we're not in that kind of easy glide path higher. We've got some stuff holding us back and some potential. So we're going to do something this morning that is not a super common approach to the markets necessarily, but something that we can add to. We can kind of add a position and then add a little bit more and then add a little bit more and so on. And I'm going to go to the QQQ, the NASDAQ 100. We've touched on this. This is kind of your big cap tech. Now, a couple of concerns here. One is this is a lot of these stocks, like the Amazons, Microsofts, and so on. Thursday's a big day. Facebook reports earnings, Amazon reports earnings. There's going to be a lot of volatility. And there could be some choppiness and some bumpiness, but we think that it just kind of makes sense to get short this area of the market, but to do it in kind of a risk-controlled way. So first, we need to ask ourselves, well, how much money are we willing to lose in this position if it doesn't work out? And we came back to about $250, $250 at risk for this position. And we said, okay, well, how could we go about that? Well, we could buy a put and just risk $250 of it, that's perfectly reasonable. That would have nice reward if we turn immediately. That would have a, quick stop out if we turn higher. It also has gap risk and some other factors. We need to consider, levels. Where are we willing to stop out? Do we want to stop out here? Do we want to stop out just a tiny bit higher? Or do we want to stop out above the highs? Well, a long put is probably going to stop you out early. Whereas if you short the stock, you can capture more of the move and do some different things. And so we said, well, if we know this is our risk, let's think about it from the standpoint of, how far we're willing to give this to move against us, and then how we might manage it. Now, 15 points might seem like a lot, $15 in terms of this position, but let's look at it. If I pull up the ATR and I'll put it above, the ATR on this is 5 points. So there's a couple of approaches to setting a stop loss. If we're looking at this, and let me get this resistance right back here, see if I can just nudge it up there. So if we were to put, the reason I was saying 15, well, I guess it would be more like 258 to 270, about 12 points. But basically, one approach is to take that ATR and multiply it by 1.5. And this is called a volatility stop loss. So 551 times 1.5 tells you to put your stop loss about $8.26 away. So if we were to short here at 258.25, to get outside of the normal day-to-day fluctuations and get 1.5 times away from that would put us about $8.26 above current prices. So 258.25 plus 826 says put your stop loss up there at about 266.51, something like that. Now that's a little bit before the resistance. We know that there's some resistance here. I would say, I would tend to agree that this is 1-2 touches. You could go up there a third time and touch and then turn back down. But I think if we get up into these levels, then we're probably going to those higher levels in all likelihood. So you can kind of go above resistance, but I think you're almost, if you go back to the resistance, no guarantees. Maybe we go back to the resistance and we fail. Anything can happen. But I suspect if we're strong enough to get back up toward that resistance again, we'll probably go through it. But we wanted to widen out our stop just a little bit more. And we were looking at kind of, that area just above this peak area, just above this big bearish candle. We have come up, and this is called price overlap, something we play from time to time. When you have a candle that stands out, you'll often get kind of rally or something back into maybe the midpoint or so. We want our stop definitely just above that. And I think using the 1.5 ATRs would probably put us up there. I don't know that we want to go 12, well, 12 would be at resistance. You'd probably have to go 13, 14, 15 bucks to get well above resistance. And that's probably a wider stop than we need. So we're looking at this and kind of saying, up in that 266, 267, that general area for a stop loss makes sense. So now we have kind of some numbers to go off of, and we say, okay, well, if we're shorting around current levels at 258, let me refresh. Let me just get, the most recent number here. 258.85-ish. So that's kind of nice, giving us a little better number. And we put our stop up there, call it 267. It'll be right up there above those levels. That kind of puts us in our risk area, and this is our risk per share. So now we have an idea and kind of an understanding of how much we're going to risk in the trade per share. Now we can take those two numbers, so 815 on your stop. This says 826. I mean, anywhere around there seems pretty reasonable. We'll probably nudge it up just that extra 11 cents. So put our stop loss at 267.11. That's perfect. And then we've got an 826 risk. Okay, perfect. And we're 1.5 ATRs above. Okay, perfect. Anything like that pretty much works. Well, if you take your risk dollar amount and you divide it by your risk per share, it gives you your position size. So 250 divided by 826, 250 divided by 8.26 tells us how many shares to trade. And we're basically at about, it's a small position size, 30 shares. 30 shares of this stock would equal $250 at risk. Now, that's your starting point. There's a couple of things about this. So let's go over here to our trade section. We can start to build this together. So I'm going to hit trade. And I'll talk about this a little bit more, but we'll get some of this working. And I go into the sell short. We'll do about 30 shares. That the market is fine. Again, we're not worried too much about the 10 cents here and 20 cents there and so on. So be it. So we come into the order here and we sold short 30 shares at 258.58. We are putting our stop loss up at about 267.11. So I can hit the trade button, go to stock, QQQ, buy to cover, 30 shares, stop loss, 267.11. And we would put this one at good till canceled. So this stop loss is going to stay out there day after day after day. Every single day it's going to be out there, and it's going to basically be our protection, our automatic exit order. Now, if that goes through in the coming days, it's probably going to happen sooner rather than later. So if we're still in this trade, let me say it this way. If we're still in this trade next week, that's a very, very good sign, because from here, as I see it, if this trade is not working, it's probably going to march right up there and hit our stop loss. This is the recovery, and this is the area that the market would have to kind of go higher from here. The reason we chose QQQ is it's all kind of the fluff. It was kind of the chase for performance, the Amazons, the Teslas, the Facebooks, all of those names, that Netflix and so on, that had that huge upside move, had those big exhaustions, and in our mind are kind of, best case scenario, we're in a sideways range that can stay sideways for a while. That's probably the best case scenario for the markets. For them to just go up, up, and away would be an extreme move. It's not out of the question that that happens, but it would really take the animal spirits kind of taking over. It would really require things to get, out of control. It would take, this is kind of where you get those frothy markets. Well, we've seen examples where froth can get just completely out of control. And usually it happens because my neighbor and your neighbor and his neighbor and their neighbor, they all start piling into a market that they've never had any experience with, but they hear about other people making money and they want to make some too. And so they rush in. And that's how bubbles form. That's what happened in the late 90s with people clamoring and piling in to buy tech stocks, and it pushed them to unreasonable levels. It happened in real estate in the mid 2000s when every Tom, Dick, and Harry wanted to invest in real estate and buy take interest only loans and own 6 properties and, yada, yada, yada. Those things can happen when everybody's neighbors start clamoring for it. Well, we're not at that point yet, but there was kind of that euphoria. There was that push, the Robin Hood traders, as they call them, the unsophisticated that kind of piled into the market. And this is an area where it can unwind, or I mean, obviously it's an area where things could you know, really take off. I mean, if things really get out of control, then perhaps there's that possibility that it's just up and away, and they just keep running after those same names. And if enough neighbors all pile in, it'll push these stocks higher. So we'll see. I think this is an area where we had that little false push higher. It's a good risk to reward, but we'll see. Now, how about the management of this? So if we're short 30 shares, there's a couple of ways that you can think about this. I mean, obviously, if it doesn't work, it doesn't work. If it comes up to 267, just above 267, then we're out of the trade. We're stopped out. So I should put it like this. Right now, we're negative 30 shares. Up there, we would buy back 30 shares, and that puts us at zero. We're out of the position, and we have our loss, the loss that we were comfortable with. Where this gets more exciting, obviously, is if this starts to work. Now, that's where different things can come into play. So imagine we start to roll over. Imagine this starts to move to the downside. Well, now all of a sudden, trade management comes in, and we say, well, if we're falling to the downside, how do we manage this? Well, if it just starts to cascade lower, that could be obviously very profitable. And we can move this stop loss down. We can move it down to a break even. We can even move it down here past break even and start locking in profits. As the position falls to the downside, maybe it gives another setup, gives a setup. And could we short more of it? Yeah, that's a possibility. We're short 30. We've got a nice built-in profit. We could short another 30, double our position size. And then if it spirals out of control, we've got even more profit. I'm not sure we would do that. And we'll look at different, scenarios as they come, and we'll try to assess the markets. But if we have a big break that's anywhere close to similar to, kind of when coronavirus started to melt down, that could be really pretty exciting. And obviously, we've got second waves and things like that. Now, I'm not rooting for any of this downturn to be fueled by anything, really. I mean, if you look at it from a dollars and cents standpoint, who cares about the money? We're talking about people's lives. So do I want coronavirus to make a positive turn? Absolutely. And not to mention, if we were looking at it in total dollars, this is going to make a small amount compared to what we can lose in our portfolios. So this is not hedging a large portion of our portfolios or doing anything like that. This is just a trade that will make some money if we have a little bit softer market for a while. So it's a little weird. We're definitely not rooting for bad news and bad things to happen, but this is a way to make money if, and really my thesis is that things got a little too frothy. Now we're in that reversal phase, and this should come back and kind of test some of these levels. And just to throw out an initial target, I think down here in that 230s range is a very reasonable price target. From 258 to 232 is a pretty good move, and I'm not sure we'll get there, but that's definitely within the realm of possibility. And a $26 move on 30 shares is 780 bucks, 3-to-1 reward to risk ratio and that sort of thing. So I think that is a very real possibility that we could get down into that level. All right, now let's look at a couple of other things here. We had a few questions in regards to Dell. So Dell is one where obviously our covered call side of this trade has gone against us. Now we're up very nicely in this position because our cost basis. So if we look at it from the standpoint of, let's go back to our positions. I mean, we're up 3,200 in the stock, but we're down maybe 700 bucks in the covered calls. Now, we'd actually fast forward to expiration, some more of that time value will come out of these options. We'll be down less than that if it were to stay here. If the stock goes higher, we'll be down more than that in these, but we'll be up more than that in this. In other words, even if they call our stock away, we're going to make good money and quite possibly even, well, for sure, more money than what we're making right now, just letting the time decay. However, we will lose our positions, meaning, they call our stock away. So we have to figure out how to get back in if we want back in, how to do that. Do we have to buy back in at higher prices and so on? And we would have to cross that bridge. So we want to retain some stock in Dell. We think that the upside is pretty significant. Even with a big profit, we still think there's more potential. You look at this, and we sold the 5750 calls and the 55 call. So is it likely that we could be called away on this? I think it's very likely. I mean, very, very good chance that this stock can stay up here. They call our shares away, et cetera, et cetera. We may buy one back. We'll cross that bridge later. But what we did was add a 1x2 put spread. Now, this is not a huge moneymaker if the stock goes higher. This paid us, I think, a 45-cent credit, something like that. So if the stock goes higher, well, this added 45 cents of benefit, 45 bucks more. We're better off by $45 than we would have been without the position, in a nutshell. But if we're in this lower level, and I would call it from about 57 to 62.50, if we're in that range, adding this 1x2 put spread adds a lot more profit, not just the 45 cents, but imagine you were at $60, it would add 250 plus the 45, so it would add $295 of additional profit to this position. So 60 would be our perfect landing spot. Now, if we were to dive below 57, then this would start to lose money. It only starts to lose really below 57. But if it's falling below 57, we know our 55 and our 57.50 covered calls are coming back into play. They're relieved of their stress. They're now no longer requiring the stock to be called away and so on. So it's kind of a bad for this if we go below 57, but very good for the two covered calls. And so it's kind of a win-win loss approach. And the only way that we're really going to regret this in significant fashion is if there was some sort of catastrophic move lower or something. Then all of a sudden we'd go, oh boy, that did not work out. Well, I don't think that's the case here in Dell. It might be at a little bit of an exhaustion, stage 4 exhaustion. It had been in a big run. Could we see some back and fill? Sure. That's kind of what we're betting on here with the 1x2. That's what would be most beneficial. But I actually think it's probably, A, the stock stays here, B, the stock might drift a little lower, and C, the stock might drift a little higher. I mean, those are all real possibilities, and I'm almost going to give them all equal probabilities. I don't know which one's most likely, a little lower, sideways, or a little higher. Heck, I got no idea. They're all about a 33% chance. I don't think that there's a huge move lower. I think that is the lowest likelihood here that we just dive and spiral and so on. And there are ways to manage this position if that's happening, and ways to look at risk and reward and improving the position and so on if that was happening. But I don't suspect that that's something that we're really concerned and worried about. Let me look here at a couple of other things. So I wanted to do an update on BAC. We had a question about this. So In the case of Bank of America, this one has been in the news a bit of late. Warren Buffett and Berkshire Hathaway actually increased their stake. They bought about $1 billion more of BAC, which is significant. Usually you wouldn't get notifications, but since they own more than 10% of that stock, you get notified. They have to register that because they're more than a 10% owner. So historically, Berkshire Hathaway has not wanted to go above 10%. That way they don't have to publish to the world that they're buying more. So for them to go over 10%, first of all, is a rarity. They're saying we really, really like something, and they bought more, and they bought more right here around 24, which is where we want to buy more. So we sold a put at 24, and selling these puts has just been working like clockwork. We've been generating income, um, and it's the best position if you're just going to hang around 24. I mean, if you said we're just going to hang around this strike price, well, sell a put or a covered call at that strike, and that's the ideal approach. You're getting at the money premium. It just keeps decaying away from time and volatility and so on. And you're in a great spot. So it's great for that neutral move if we're just going to gravitate around a certain level. And we've done this for the past few months, and it's worked like clockwork. Well, all good things come to an end. And that's kind of where we feel like we're at in this BAC is, at this point, we've kind of been in this consolidation pattern, and we're probably on the cusp of a move. Now, if you look at this on, there's your symmetrical triangle. If you look at this with Bollinger Bands, let me throw that on there, you'll see how they're kind of squeezing up a little bit. Is it getting ready to move? Yeah, probably in the not too distant future. Now, still in kind of this tug of war, we've got to make an assessment. Well, is it going to go lower? Because we could buy back our puts, lock in the profit, and then always come back and pick up the shares at a discount. Is it going to break out of this and go higher? In which case, we'd rather just buy the stock, hold the stock for that big upside move, because the put will only make us the premium, make us the $1.05, I think, or whatever we collected. But if the stock's going to go up 3, we'd rather make 3 than $1.05, right? And so, assessing that, well, the naked put is still a pretty good position in terms of the unknown. If we felt like it was really starting to break higher, there would be other ways to better capitalize on that than the naked put strategy. If we're going to go lower, the naked put requires us to buy stock at 24. We get to keep the 105, so we're buying it at a 295 cost basis, but we're still buying it at 22.95, even if it's down here at 22 or 21.50 or whatever. Now, we think that there's pretty good support here. I think the possibilities of Bank of America going up for a while, I think it's in a really good spot fundamentally. And like we said, we think this stock is going to be in the 30s. It's just a matter of when, not if. That's our opinion. Doesn't mean we're right, but that's our longer term outlook. So we're probably going to look at plays that give us more upside. That would be the approach, is saying, okay, well, what can we do to capitalize more on the upside movement if this is going to run higher? We're not deeply concerned about a big breakdown here. I think if the markets break sharply lower, certainly possible, I would expect these banks to actually outperform, maybe hang in there pretty well, and so on. So looking at this from the standpoint of opportunity, what would give us the best way to capitalize if BAC were to work its way higher, and kind of be a low risk approach to that? Well, here's where sometimes these diagonal calendar, those types of positions can make sense. Let me pull up some options here. And there are really low risk ways to do this in stocks like Bank of America, because you're looking at this and the stock's at 24.17. Now, the idea behind a diagonal or a calendar is one where you kind of say, okay, maybe I think we're going up to these higher levels overall, but it's going to take some time to get there. And so I can sell short term. I could buy a long-term call and sell a short-term call. As the short-term call expires, because expiration comes for the shorter term quickly, as it expires away, well, now I still own the longer term and I can capitalize on it, continuing to work its way higher and so forth. And that's kind of the concept here, is saying, in the case of BAC, what if we said we buy a calendar call spread up here at 26? Well, even if we start to shoot higher, by August, the 26 call is probably going to expire. But now we used to own let's say hypothetically we bought a January 2021 26 strike call. Well, when we bought it, it was out of the money by $2. Now the stock's gone up here, and not only did the short-term covered call expire, we made that money, but our longer-term option has now become an at-the-money call. And so do you think it makes sense, to put on that type of position where the short-term rolls away, but the long-term goes from out of the money to at the money, and then hopefully keeps climbing to in the money? And as it keeps climbing and goes further and further in the money, this just keeps making more and more profit. In addition, we could keep selling some short-term calls against it for income. And that's kind of an interesting approach. And it doubles down on the bullishness. You're doubling down on kind of your aggressiveness here in terms of kind of expectations and what you're trying to capitalize and so on. But it can be a fun way to do it. It can be a fun approach to kind of managing these. So let's come over to Thinkorswim and look at this approach. I'm going to go into trade. We'll go BAC and find just Bank of America right there. Select that, 24.24. I'm going to come out here a ways, and again, I want some time on the call I'm buying, and we were going to go out here something like the 26, and I'm going to look at buying a calendar. So let's take this down to one contract and just assess. So here we say, okay, let's change our expirations, buying the January. Let's see what selling the August will do. Now, we've got to glance at the August to make sure there's enough premium to even make it worthwhile. There's not going to be a lot. It's just going to be a little bit of premium. But hey, there's 30 cents there. So 30 cents on a $24 stock, that's over 1%. So that's decent. Now you look at this diagonal, or this calendar, pardon me, and we're buying and selling both the 26 strikes. So we're literally buying the right to own the stock at 26 and then giving someone else the right to own the stock at 26. But of course, the August floats away in a couple of weeks. The January lives on. Let's analyze this trade. I'm going to right click and hit analyze. Now I need to make sure nothing else is selected here. Okay, uncheck that. Let's make sure that the stock is unchecked just in case. So there's your call calendar. And this is basically what it looks like. Here's the stock right now at 24.19. And it's giving you an assessment of, well, where's your max profit? Well, our max profit is if we can get up there near 26. 26 at August expiration would be the ideal spot. Now, this isn't a life changer. You can see that there's about almost $100 of profit in it between now and August. But there's a lot more.
Hey Corey, it looks like you lost audio.
Well, I'm not sure when I clicked that.
Yeah, it's been about a minute, so
Okay.
you
Well,
might
let
want
me
to go
go
back.
back. I'll go back just a step. I know I've got a little audio button and I moved around on my chair and it probably clicked against the chair and muted me up. So sorry about that. Let me just go back a step and say that notice that in terms of this risk graph, we own the 26 in January. We're short the August 26. Our max profit is up there at 26 at August expiration. About $100 of profit potential is what we could be up. We start to lose immediately, almost immediately on the downside. There's just not a lot of downside padding before we get down here to break even. So at $23 per share, we've got a $40 loss. At $22 per share, we're down 50 bucks. At 21, we're down almost 100 bucks, and so on. At 20, we're down 100. And the further it goes down, the more we would lose. This is a bullish trade. We've got it targeting an upside move. But you'll notice as we climb 25, 26, we make money. Even if we overshoot the mark, 27, we're still profitable, but not as much. 28, still profitable, but not as much. 29, now we're starting to lose again. We're below the zero line. So this is an area trade, but the area is positioned above the market. So above current levels at 24.17 is kind of what we're targeting. That's where we would start to make money in this position, is at that, 26 level is max profitability. Now, if we overlay this and do it in combination with our existing naked put, we're basically adding another bullish element to an already bullish trade. And you know what? We're comfortable with that. We kind of look at it and say, well, if it goes down, we'll reassess and we'll have to make adjustments as needed and so on. And both of these can lose. I mean, that's the risk and reward of it all. But the way we see the markets, we're not as concerned about the downside. So we think that the upside is the way to trade it and kind of the opportunity here. So if we jump over, we can do this within Robinhood and save ourselves a commission. If I go BAC, I'm going to hit trade BAC options. We're going to buy a call with a January 15th, 2021 expiration. We're going to sell a call. So I need to click the sell button with an August 21st expiration, same strike price. And the total cost on that's about $1.36. That seems reasonable. That's about the midpoint. Anywhere around there, that represents $136 is your maximum risk in this trade. And, it's kind of a trade from now to August. From now to August is what we're looking at, that first, initial push here. And then once we get to August expiration, then we've got to reassess and say, okay, well, what do we want to do with that January call at this point? Because the August has gone away, or we need to buy it back, or what have you. And again, there's kind of a management process to this where the January, we know we can make further adjustments to that option to reduce risk. So imagine, for example, let me give you a hypothetical. Right now we're at 24, 15 or whatever per share. Let's imagine that we finish at 25. Well, if we finish at 25, the August 26 calls expire nicely away. And couldn't we sell another one? Could we sell a 27 call for September and bring in another, 35, 36, 37 cents? Let's say we bring in 36 cents for that. Well, right now we're buying this total spread for $1.36. So if August goes away and we can sell the September 27 calls and bring in 36 cents, we just knocked our risk down from $1.36 to $1 at that point. And if September goes away and we can sell in October, we can further reduce our cost basis and our risk and so on. That's just one example of kind of, with these calendar diagonal type of trades, you can further reduce your risk over time by selling shorter dated options against it. The best case scenario for us is that the stock climbs up, with $26 being our price target at August expiration. That's where maximum profitability comes in. So hope that gives you some idea of how that works. Let me check my notes here. So a couple of other August expiration positions that we need to update. One is CVX. So Chevron has been in the news a little bit. Now we have a naked put on this that we feel pretty darn good about. We sold I think we're short the 80s, if I remember right. The 80 strike put. Does it look like it's going to expire above 80? Yes, no guarantees, but certainly looks like it's on the path towards expiring with the stock above 80. Now, if it were to get down there towards 80 or below, we would take ownership of the stock, but we would be pretty darn happy to do that. I think that would be, a gift of sorts. Chevron, I think, kind of fleeced another energy company. If you go in and dig into the details, it's really interesting. They bought Noble Energy, or they haven't closed on it, but it was announced within the last week or two. What's interesting is, they have to take on Noble's debt and other factors, but if you look at what it gives them in terms of opportunity versus risk, it only bumps up their total debt numbers by like 3%, but the amount of output in terms of oil and upside and potential, it's like buying a tiny little call option that has a huge expected payoff. So they're kind of looking at it as, heck, we're taking very little risk in this, really, in my approach. They're adding 3% of risk that can add 50, 60, 80, 90, 100, so much upside if oil recovers over time and so on. And I think it's a great risk to reward for them. I think the reason that they can do it is because other companies are just kind of floundering and worried about the future. And it makes sense for a company like Noble Energy, where they're like, okay, look, we've got great assets, yes, but we've got other concerns, all this debt and these problems, that if we have to keep paying this debt at high interest rates, well, it's going to take away a lot of our profitability. And if oil prices don't rebound in the short term, we might be in a lot of trouble within a year or two. So if we align ourselves with Chevron, we get to become owners of their stock. And if together we create a great business that flourishes, look, we're going to participate in that upside, because we become, they're spending cash and Chevron stock, so that Noble Energy owners become Chevron stock owners. And if the stock flourishes, well, they'll flourish. But also, Chevron can redo the debt under the Chevron name and pay much, much lower interest, et cetera, et cetera. So there's all these advantages to them teaming up, but it's all because Chevron's in such a great spot. And so it gives Noble Energy kind of this lower risk dynamic where they're like, look, we're not going to lose everything here. But if we go it alone, yeah, we would have more upside if things recover, but we have a heck of a lot more downside if things don't. If we align with Chevron, well, we're taking the lower risk, lower reward outcome, and they're comfortable with that. But it just really makes a ton of sense for Chevron. So if I was bullish on it before, I'm super bullish on it now. I think that's the way this deal shapes up and looks fantastic. So if you get into merger arbitrage and different ideas like that, let me show you a couple of things here. So let's go through and work some of these numbers. I thought this was kind of an interesting way to look at this. And what merger arbitrage is basically looking for pricing discrepancies in the way that the deal is constructed, and then saying, okay, well, which one's the better buy and which one offers more upside and so on. So here's kind of some details of this deal. If we look at it, Chevron's going to acquire all outstanding shares of Noble Energy in an all-stock transaction valued at $5 billion or 1038 per share. So they're giving you some numbers here to already work through, and they're saying, okay, we're going to take out Noble for 1038 per share. Now the stock was trading, a little below that before the deal was announced. In fact, if we click back to the chart, it was trading in the 9 something range or whatever. And here's the deal terms. Based on Chevron's closing price of, and under the terms of the agreement, Noble Energy shareholders will receive 0.1191 shares of Chevron for each Noble Energy share. So the total enterprise value, including debt, so they're taking on their debt, their whole enterprise value, $13 billion. Now, that's how many shares they're getting of Chevron for every one Noble Energy share. So if you're buying Noble Energy, you have to kind of look at this and say, okay, where's the stock trading? Well, 1065. So it's at 1065 right now. And if I buy one share at that price, how much am I getting of Chevron when it converts? Well, I'm getting 0.1191 CVX shares. So I need to look at CVX, which is trading at 89.35, and so say, okay, well, if Chevron's trading at 89.35, what's that times that? Let me see which one gives me a better value. 89.35 times 0.1191 equals 1064. And here's what you're going to find is basically they're trading for the deal price already. Buying one share of Noble Energy is like buying, one share. It's like buying 0.1191 shares of Chevron. They're priced about the same. If there was a discrepancy here, sometimes when there's a buyout, there would be an advantage to buying one over the other. For example, what if Noble was trading at, let's say it was trading at 10 bucks? Well, then you'd be better off buying Noble Energy. Why? Because if I buy one share at 10 and then it converts to that amount of Chevron, okay, and that amount of Chevron, we've already said, 0.1191, for every one share I own of Noble, it converts to that many shares of Chevron. And if Chevron was trading at this, 89.35, then it's worth 1064. So if I can buy Noble Energy for 10 and it converts to a value of 1064 at the deal closing, I'm getting 64 cents better for buying Noble Energy. The problem is in this situation, they're priced equal. Buying a share of Noble is basically the same thing as buying 0.1191 shares of Chevron. You end up in the same spot. So it doesn't matter which one you buy. Merger arbitrage is about trying to buy the better value. And sometimes there's a little bit better value. This will happen usually when the deal's more in doubt. It looks like that's pretty ironclad in the market's opinion. The market's opinion is that that deal is going to go through and it's just, kind of set in stone. Sometimes there will be those advantages though, like say that ABC Corporation comes out with a deal to buy XYZ and they're going to pay $75 per share or something for XYZ. Well, oftentimes XYZ will only gap up to $72 per share. Why? ABC's already said, look, we're going to buy you out and we're going to pay you 75 bucks in cash. If it was a cash transaction, it's really simple calculation. Well, they've told me they're going to pay me 75 and I can buy it at 72. Okay, I've got $3 of value. There's my arbitrage. I can buy it 72 and I'll get 75 down the road. But why would it trade at a discount? Well, it would tell you a couple of things. It would tell you that while you have $3 of probable upside, the market must feel like there's a lot of considerable downside risk. That would be a scenario where they're worried the deal might not go through. Maybe it won't get regulatory approval. Maybe the deal breaks down because the economy goes through coronavirus or whatever. Maybe the deal breaks down because this company, the shareholders vote not to allow it or whatever. There could be different things that happen. And if the deal falls apart, you thought you were going to get 75, but then your stock tanks and it goes back to 60. And you bought it at 72, trying to make that $3 arbitrage, but you took $12 of risk, right? So the deal breaking down creates big risk, but probably you're going to make that extra three. This company said we're going to pay you a higher price than where you're trading, and so that's the risk to reward of trading these deals, is you have probably $3 of upside hypothetically, but you have a lot of risk if the deal falls apart. There are rare circumstances where a company will come out and bid 75 and then the stock will trade above it and it'll trade at 77. And people will go, well, wait a second, that makes no sense. What's happening here? They're only going to get 75 and the stock's at 77. Why in the world would that happen? Well, that's when the market sniffs out that there's probably another bidder. And so it trades above the deal price because they expect somebody else to come in and bid over the top. And then sure enough, the market's often right. And, Microsoft bids 77, but then Google comes in and bids 80 and so on. And all of a sudden there's a bidding war. That's a rare circumstance though, but it can happen where a stock will trade above the deal price because it looks like there's going to be a feeding frenzy. Not common, but when it happens, I'm telling you, the markets are smart. And if it trades above deal price, somebody knows something, and there can be a bidding war or something happening there. So kind of interesting stuff. Yeah, you can do merger arbitrage through the options market. One of the best trades I've ever had, this was years ago, but Berkshire Hathaway had a deal to buy Burlington Northern. Now, Burlington Northern used to trade, it's a rail company. It might have traded under BNI or something like that. It doesn't exist anymore because Berkshire bought it out. But when they announced the deal, the stock was quite a bit below the deal price. And I actually bought options to profit from it going up to the deal price over time. So I don't remember the exact numbers, but maybe it was trading at 70 and the deal was going to go down at 80. So I bought call spreads with longer term expirations to profit from that move from 70 to 80 and made a killing. And, there was risk to that, but I felt confident that Berkshire was going to go through with the deal. I thought if anything, someone's going to try to outbid them, which would mean the stock would go up even higher, but that's probably not going to happen. Berkshire is not going to walk away from this deal. When they make a commitment like that, it's pretty uncommon for them to walk away. And, I ended up being right. So there's examples of arbitrage, merger arbitrage, as they call it. All right, that's it for today. Hope you've enjoyed this class, and we'll be back next week, same time, same place. Let's see, we're still a couple of weeks away, a few weeks away from expiration, but we'll be back next week, same time, same place, and we may have some additional updates, adjustments, and so on. Before we do, let me actually just check, did we get filled on this trade here? Where is our BAC? One thing I've noticed, I don't know what's happening here with Robinhood. So it still says it's a pending order. So we have not been filled yet, but it's a little bit of a slow, kind of wonky platform. But anyway, we'll leave that live at that $1.36 price and see if we can get filled here today on that call calendar spread. If we don't get filled today, we may well try again tomorrow at that same basic price and see for a day or so if we can get filled on it. Thanks again, everyone. Have a great rest of your week, and we'll see you then. Goodbye.